Good morning and welcome. Moss Adams is pleased to present today's webcast, the Form 990 Back to Basics, Understand Your Grantees Stories to members of Southern California Grantmakers and Philanthropy Northwest. And before we begin today, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Good morning. This is Cameron Green. I am the Director of Professional Learning and Communities at Southern California Grantmakers. We are so pleased that you all could join us for the Form 990 Back to Basics, Understanding Your Grantees Stories. And Southern California Grantmakers is pleased to partner with Moss Adams. So we appreciate you today, and we hope that this presentation is useful to you. And with that, I will hand it over to Emily. Thank you.
Thank you, Cameron. I'm pleased to introduce today's presenters from Moss Adams, Tracy Paglia, Partner, and Mike Lumsden, Tax Senior Manager. Tracy is a tax partner with Moss Adams, specializing in tax-exempt organization issues. She is a highly rated national speaker on tax-exempt issues, an associate member of the AICPA's Technical Resource Panel, and program co-chair of the TEGE Exempt Organizations Council. Mike has practiced public accounting since 2010 and specializes in helping tax-exempt organizations address compliance and consulting tax issues. He has served a wide variety of tax-exempt organizations, such as foundations, museums, healthcare organizations, and social service organizations, amongst others. And with that, I will turn it over to Mike to get us started.
Thank you very much, everyone. Before we do a deep dive of the Form 990, I thought it might be helpful to provide some background on the form itself. Now, the Form 990 is an IRS filing required of all tax-exempt organizations. The form is actually not what I call, or it's actually what I call an informational tax filing rather than an income tax return, as there really is no tax paid with the form itself. Any taxes are actually paid with the supplemental separate tax filing, such as the Form 990T. The Form 990 and all schedules, except for the names and addresses for the organization's donors on Schedule B, the Schedule of Contributors, which is a schedule we'll cover later in the webinar, they're available to view by the public via websites such as GuideStar or via a request from the organization itself. As such, most organizations and their tax advisors put in a lot of time and effort into drafting these filings, as it's one of the most public-facing documents for tax-exempt organizations. The purpose of our session today is to really assist the readers of the Form 990 to help guide them as to what exactly is being analyzed on the form and to help highlight some important schedules. Now, sadly, we don't have time to cover every schedule on the Form 990, but we did want to review with you those we typically see get looked at the most. Our session will cover the Form 990 chronologically, so if you have an example Form 990 you'd like to follow along with, please do so. Now, jumping into the presentation, we're going to start with Form 990 Part 1, which is the first page of the form. Within this page, which we call the summary or snapshot of the organization, you're going to note some general information about the organization, as well as summarized financial data, which is elaborated on later on within the form. There are some notable line items here to highlight on this first page, however. On line 1, you're going to that's where you're going to see a few lines actually devoted for the organization to describe either their mission or their significant activities. This can be whichever the organization wishes to highlight. But typically, this elaborates on exactly what is their exempt purpose. Often, you'll be able to tell a lot about exactly what activities an organization undertakes via just these few lines. Additionally, on lines 3 and 4, here you're going to find information about 1, the number of voting members of the board at year end, and that's actually on line 3. And on line 4, of those board members, the number of which are independent. We find this as super useful information to readers, as ultimately it tells them just how strong the organization's governance is and whether the tax-exempt organization is governed by disinterested individuals. Now, there are a few items which can hinder independence of a board member. The most common examples we see are 1, if the board member is also compensated as an officer or other employee of the organization. Often we see, CEOs or other executives who receive compensation. They sit on the board. So obviously, this would cause these individuals to not be considered independent. The second item is if a board member receives compensation for services in excess of $10,000, which we see on occasion as well. The third item is if the board member has a transaction listed on Schedule L, which is a supplemental schedule to Form 990, which we'll discuss later. These transactions can range from a variety of items, including whether a family member of the board member receives compensation, or if a business controlled by the board member participates in a business transaction with a tax-exempt organization. The last item we wanted to highlight on page 1 of the Form 990 is the level of unrelated business revenue generated by the organization. And these are revenue streams which are actually taxed by the IRS. You can find detail as to just what exactly these unrelated business activities are by looking at Form 990 Part 8, which is the Statement of Revenue, or by requesting a copy of the organization's Form 990T, which is also required to be made available to the public. Typically, you want to see a lower percentage of unrelated business revenue to total revenue. There really is no bright line test for saying how much unrelated business revenue is too much. But typically, anytime this creeps up below 15 to 20%, it will start to be analyzed by the IRS just to see if the organization truly is operating as an exempt entity. All right. Now, turning the page, and if you're following along with a sample Form 990, we're going to run into Form 990 Part 3, which is the Statement of Program Service Accomplishments. Now, this section really is what I call a great PR opportunity for the organization, as it really is the chance for them to tout exactly just what was accomplished throughout their tax year in support of their exempt purpose. Line 1 of this section is actually reserved for the organization mission, and it actually should be their board-approved mission. And it can be identical or different than what was on Part 1, Line 1, which we just covered. It ultimately just depends on what the organization actually wants to input on Part 1, Line 1. Something to note, though, here is that this section actually has limited room. So if it appears the mission is actually cut off, The disclosure likely runs on Schedule O, so you want to highlight Schedule O of the Form 990 if it does look cut off. Lines 4A through 4D of Part 3, now this is really the PR section of the form, and it is the opportunity for the organization to disclose exactly what was accomplished in support of their tax-exempt purpose. Here, oftentimes, organizations will highlight figures such as grants paid out or the number of individuals assisted by the charity throughout the year. Also, on lines 4A and 4C is where you can highlight the top 3 programs. And some organizations might just have 1 program. Some organizations might have 3 or 4 programs. It ultimately just depends on how the tax-exempt entity wants to break up their activities. There really is no science to it. So don't be alarmed if one organization has 1 program versus another organization you're analyzing has 3 or 4. Now, turning the page one more time, if you're following along with the sample Form 990, we're going to run into Form 990 Part 4, which is the checklist of required schedules. And this section actually covers 2 pages of the Form 990. I call this section really the roadmap to the rest of the Form 990. And what it is, it's a questionnaire completed, and the yes-no questions here really dictate what supplemental schedules, and they're Schedule A through Schedule R, what supplemental schedules the organization will have to complete. Now, many times the responses to this section stay consistent year to year as the activities of the organization doesn't change much. We did want to highlight some questions within the section, which we actually won't go into greater depth within this course due to time constraints, but we did want to at least cover or touch on. The first one is questions 4 through 6 of Part 4. Now, these are questions inquiring whether the organization incurred any lobbying or political activities during the year. If so, the organization would have to complete Schedule C of the Form 990. Now, to provide some context, 501c3 organizations, like any other type of organizations, can undertake some limited lobbying activities, but they're not permitted to undertake political activities, which would be supporting or opposing a candidate for public office. So if these questions are marked yes, you can likely inquire more about exactly what lobbying activities, since these are really the only lobbying or the only activities permitted by 501c3 organizations. You can inquire what type of activities were undertaken on Schedule C of the Form 990. The other set questions we wanted to kind of highlight were questions 14A and 14B, and these inquire about the foreign activities of the organization. Yes responses here require the organization to attach Schedule F, where you'll be able to examine any foreign grants the organization might give out, program service activities included in foreign or incurred in foreign countries, as well as the value of foreign investment. Turning the page, if you're following along on a sample Form 990, we'll run into Form 990 Part 5, which is a statement regarding other IRS filings and tax compliance. Now, this section really is a checkup for the organization to really ensure they've complied with filings other than the Form 990, which might be required by the IRS. On lines 3A and 3B, you note questions regarding if there was gross unrelated business revenue in excess of $1,000, and $1,000 is the actual threshold for filing the Form 990T. Also, there's the question on 3B if the organization then has filed the Form 990T. Additionally, on lines 4A and 4B, you'll note questions regarding any foreign bank accounts which might be held by the organization. Now, if the organization had bank accounts with an aggregate value in excess of $10,000 USD at any point during a calendar year, FinCEN Form 114, which is kind of often called the F-bar, would be required. Failure to file these can actually lead to really stiff penalties for the organization, and it's something we as tax preparers examine closely to ensure compliance. The last item we wanted to highlight on this page is questions 6A through 7H, which are requirements of the organization associated with contributions it might receive during the year. Now, the organization might have to undertake some additional filings with the IRS depending on whether it receives certain non-cash charitable contributions, such as cars or automobiles. Additionally, let's say the organization received a payment, let's say for a gala, where a portion of the ticket price can be treated as a charitable contribution to the payer and a portion non-deductible to the payer. This section is where the charity can affirm that they've notified the donor of the non-deductible portion of the ticket price as required under the tax code. All right, turning the page to Part 6, and we're going to start with Section A, which is the top section of Part 6. And this really tells us information regarding the overall governance of the organization, as well as the governing body. Within this section on lines 1A and 1B, you're going to find duplicate information, which we already covered on page 1 of the Form 990, regarding the number of voting members of the governing body at year-end, as well as those which are independent. Another item, though, we wanted to highlight in Part 6 is line 2. And this question asks if there were any business or family relationships amongst board members of the board or of management. Now, a yes response here would prompt the organization to disclose in Schedule O exactly what relationships were held. Now, the fact that this is marked yes actually doesn't hinder independence of any of the board members, but the IRS found that it would be pertinent to readers to include this question just to disclose to the public how closely intertwined the governing body is and whether the governing body represents a wide spectrum of the general public, which is something sometimes scrutinized for some public charities. Within Part 6, you'll also note a question on line 5. The question reads, did the organization become aware during the year of a significant diversion of the organization's assets? The IRS is interested in this as the IRS wants to know about any unauthorized conversion of the organization's assets other than for the organization's authorized purposes. And this could range from embezzlement, theft, or even being the victim to phishing scams resulting in the organization accidentally incurring a financial loss. The organizations don't have to check yes to this question for all occurrences of misuse of funds, only if the amount involved exceeded the lesser of 1, 5% of the organization's gross receipts during the year, 2, 5% of the organization's total assets at the end of the year, or 3, $250,000. One item we did want to highlight, though, is a yes to this question often might trigger an IRS audit, or at least for the IRS to examine exactly what happened. So if this is marked yes on your Form 990 or Form 990 which is encountered, the organization needs to be prepared for some inquiries regarding the IRS regarding this. Not turning the page, on that same page on Part 6, Section B, which is the bottom half of Part 6, this covers the policies and procedures the organization has in place. Generally, we like to see a lot of yes responses in this section, as it designates that the organization does have strong policies and procedures. We often tell organizations who might mark no to a question within here to actually put in place certain policies and procedures, such as a written whistleblower policy or a document retention and destruction policy. Now, even though the information within this section generally isn't required under the code, the IRS considers such policies and procedures to generally improve tax compliance, and the absence of these policies and procedures can lead to opportunities for excess benefit transactions, inurement, and other activities inconsistent with tax-exempt status. Some items to highlight here are line 11A, which is the question regarding whether the Form 990 has been provided to the board prior to filing with the IRS, which in general just shows good governance. I've had some entities that I work with, they say donors actually look for this and actually determine whether to make a charitable contribution based off whether this is marked yes. So we generally suggest to all organizations that the Form 990 is at least circulated to board members prior to filing. You actually don't have to formally review it with them, though. Additionally, on lines 12A through 12C, you're going to see questions regarding the process for monitoring and enforcing the organization's conflict of interest policy. And this is to ensure that those charged with governance, the board of directors or management, that they aren't making decisions within the organization which can benefit him or her. The organization actually is required to disclose in Schedule O how they monitor and enforce compliance with the conflict of interest policy. And typically what you want to see from the disclosure is that it's covered that the conflicted individual is not allowed to participate in the decision regarding a proposed transaction, which could in some way benefit the individual. Lastly, on lines 15A and 15B, you're going to see questions regarding how the organization established compensation for officers and key employees. And this is super pertinent within the tax-exempt space, as all compensation must be reasonable. And to determine reasonableness, you want to see that there's some type of comparative studies done to determine that it is market value and that individuals aren't overpaid within the organization and they're not privately benefiting from the tax-exempt status of the organization. And with that, Tracy is going to cover Part 7, which is some compensation issues.
All right. Thanks so much, Mike. So Part 7 of the 990 is one of the most highly viewed sections of the 990 because it's listing compensation by name, by person. So it's very sensitive. It's not able to be redacted. So any copies of the 990 that you're viewing from a grant recipient should have this information. People would like to redact it, but you're not supposed to. Any copy that goes out should have it. So you're going to be listing, or the organization is going to be listing, directors or voting board members who are there at any time during the year. It can get a little confusing when you've got fiscal year versus calendar year organizations, but for the first two, directors and officers, that's based on anyone who is in that position during the fiscal year. So directors are going to be voting board members, not advisory members, and officers are those people who are designated in the bylaws or articles or other organizing documents as officers. Your typical president, treasurer, secretary, those types of positions. You're also going to have your top financial official and top management official there. So they're all considered to be officers. Key employees then are listed, as well as the next 5 highest paid. And there's certain thresholds, so you may or may not have a lot of names here for your grant recipients, depending on how highly paid their people are. Because in order to be a key, you have to be paid at least $150,000. And to be a top 5, you have to be paid at least $100,000. So it's not unusual, especially for some smaller grant recipients, to not have any paid people listed, because maybe their officers are volunteers and they don't have anyone else who's paid over $100,000 or anyone who's paid over $100,000. We also do have a requirement to list formers. So sometimes you'll see names on there of people who you know have rolled off the board or are no longer with their organization, but because they receive compensation over certain thresholds, they still need to be reported. So this is all going to be on calendar year. It can also be a little confusing when you've got a fiscal year organization, trying to figure out what's fiscal year, what's calendar year. Anything you see on Part 7, as well as on Schedule J, is going to be based on the calendar year that falls within the tax year that's being reported. So sometimes it can be dated, and you see names on there of people who maybe have left the organization a good long time ago when you're looking at the return, but because it's a calendar year reporting, they might still be listed. On the screen, you have a kind of a snapshot of Part 7 of the header. Also, hopefully you have a copy of the 990 and you're following along. So it is a little hard to read on the screen, of course. But in column D, you have compensation that's paid by the filing organization itself. But then in column E, that will give you a hint if there's any related organizations that are also paying the same person. It's not uncommon in a multi-entity group that you'll have a person that's an employee for multiple organizations. Maybe you have the same CEO across several different organizations, and maybe they get a couple different W-2s, or they've chosen to split the compensation in a way that they're reporting it here as split. Column F is going to have your non-taxable benefits that are from the organization and related organizations. And that's often going to be any deferred compensation that the employer is contributing to, and any non-taxable benefits like medical or dental, those types of things. So especially in the compensation area, but also throughout the rest of the return, it's really important to understand if the organization is a standalone, just a single entity, or if you're looking at one entity that's part of a bigger group. Because especially once we get into the next few pages of the return, if they're in a multi-entity group, you can get some kind of skewed numbers when it comes to revenue and expenses, and even balance sheets sometimes. So later on in the presentation, Mike will show you Schedule R. R is for related organizations. But as someone who's looking at the 990, this might be your first indication here, if you're going page by page, that you have a related organization. You're looking at one as part of a group. But Schedule R would then tell you the names of those organizations, if they're taxable entities, if they're other nonprofits, to give you a bigger picture of the type of organization that you are looking to fund. So with that, we come to a polling question here.
Okay, our first polling question. Compensation on Form 990, Part 7, Column D, should tie to which of the following amounts? And your options are A, Form W-2, Box 5 or 1, whichever is higher. B, compensation paid to employees for the fiscal year end for which the Form 990 is reporting on. Or C, neither. The organization can estimate the amount reported in column D. And I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit submit. And let's go ahead and see what everyone has to say. Tracy, back to you.
All right, so we have a split between A and B. So just to reiterate, Part 7, regardless of the organization's fiscal year, is always going to be on the calendar year. And Form W-2 is where the organization reports to the IRS the calendar year compensation. And so the number to pull is either Box 5 or Box 1, whichever is higher. So that will be A is our correct answer for today. All right, so we're going to move on to the next part of the core form. If you're following along in the form itself, this is going to be Part 8, Statement of Revenue. And this is going to basically follow the presentation of financial statements, but we do have some differences on the tax return. So when we're preparing returns or when we're looking at audited financial statements comparing to tax returns, we always want to understand why there's differences between the audited financial statements and the returns so we can know that the return is prepared correctly and consistently with the audited financial statement. So hopefully as part of your grant recipient vetting, you're asking for both the audit and the tax return. Not everyone does, but you should be able to track between the two. Some of the big differences are for tax return purposes. The IRS says we do not include donated services. So I'm a CPA. If I donate my time to an organization, it might be significant enough for their financial statements that they would want to accrue that expense on their financial statements and show it as a donation. But the IRS says I, as an accountant donating my time, I don't get to take a tax deduction for that. Therefore, for tax return purposes, the organization doesn't include that as donation revenue. So we could have that difference. Another one that we often see is unrealized gain or loss on securities or assets. For financial statement purposes, you're usually marking your assets to fair market value each year, so you have an accurate representation of the assets of the organization. But for tax return purposes, the IRS says, no, that's not realized yet. We're not going to have you report it as revenue until you actually sell the asset or otherwise realize that gain. Our revenue in column A is our total revenue for these adjustments that I just talked about and a few others. And then we break that down between program or related revenue, unrelated revenue, which often is going to track to your 990T and could be taxable income. And then column D is your items that aren't program related. They aren't driven by program operations, but they aren't taxable. So they meet a certain exception, like your investment income often, unless if it's debt financed, is going to be in your column D, or your unusual items that aren't frequently occurring, like your special events. Program revenue, one of the things you can do as an organization reviewing the 990, getting to know the organization, is looking to see where that program revenue on line 2 is coming from. And you can compare that to total revenue to see if that's where they're getting the majority of their support, or if it's line 1 contribution revenue, if they're really relying on grants where they're getting money from the grantor but they're not providing services in return. That's a donation or contribution. Or are they relying heavily on investment income, which can really skew from one year to the next? So it gives you an idea of, at least for the return that's being presented, where the majority of their revenue came from. And in column C, if you have a whole lot of unrelated revenue that could be taxable, it can be a flag that the organization might be spending too much of their time and energy generating that revenue and could have their exempt status at risk. There isn't a bright line test there, but often if that number is large, that column C unrelated business income number is large, it makes us kind of pause for a minute and make sure that the organization is actually spending their time on exempt activities. So the next section after that is Part 9, our Statement of Functional Expense. This is also highly viewed. Often you'll hear organizations tout that, 80 cents of every dollar they spend goes to programs. Well, this is where you'd get that type of information. So in Part 9, we have our total expenses, and we break it out into 3 different columns: our program service expense, our management and general expense, and our fundraising expense. So this is where it's also important to understand if you're looking at one entity in a multi-entity group or a standalone. The reason being, if you have, say, a hospital that's part of a multi-entity group, you might be looking at the foundation's return. And the foundation should have a whole bunch of expenses in column D, and they might have a whole bunch of contribution revenue on the previous section, the statement of revenue. It might be that they have a whole bunch of fundraising expenses, but the contribution revenue is shown on the hospital's return. So it could look very skewed that you have a whole bunch of fundraising expense, not a whole lot, if any, program expense other than maybe grants that they've paid out, but then no contribution revenue or not as much as you'd expect. So assuming you have a standalone, though, some of the ratios that you can analyze are looking at the ratio of program expense, so column B, compared to total expense, management in general compared to total, and fundraising compared to total. Looking to see for every dollar they spend, where are they spending it? What types of activities are they spending it on? Now, it's warning flags, if you're not part of a multi-entity group, to have 100% of your expenses in the program column. That is not reasonable or realistic. If you have an organization that says they're spending 100% of their expenses on program, my guess is they haven't thought about where the expenses are actually going to. I also have a concern that the organization has appropriate management, because if you have no expenses in the management in general column, how are you functioning, right? Someone's got to do the internal accounting. Someone has to do the behind-the-scenes work that you wouldn't consider to be actual program services. The other thing on that, where each dollar goes, is some of the state attorney generals have gotten very picky about organizations that don't have enough in the program column. So let's say that you have an organization that for some reason they're not putting more than 50% of their expenses in the program column. There are some states who would look at that and say, are you really fulfilling a charitable purpose, or are you really just a management entity that is somehow filtering the money somewhere it shouldn't be going? Are you operating within your charitable purpose? And they see that as a red flag. So just look for reasonableness, and if you see something that doesn't look right, ask additional questions. The other ratio here is your fundraising expenses in column D compared to your contribution revenue on the previous statement of revenue we were looking at, line 1. And this is the kind of the fundraising efficiency ratio. But you can't really look at this on a year standalone basis, because we know that when you spend an hour today on fundraising efforts, it's not going to translate often to $1 or more, or hopefully a lot more, of contribution revenue today. Often it's a long play where you've got expenses you're spending today to bring in revenue in future years. So that second ratio of fundraising expense to total contributions is one you really want to watch on a trend line, because if you have a big, say, capital campaign, a potential grant recipient is in the middle of the capital campaign, their fundraising expenses are going to be high, but the revenue might not roll in for a couple years. So it's not unusual for that ratio to bounce between 12% one year, 30% the next, kind of be all over the place. But looking at it over a trend line would give you an idea of really, are they putting their fundraising dollars where they should? Are they really getting the bang for their buck that they should be for their fundraising activities? Same type of thing with the first ratio, looking at that on a trend line just to see if the organization is consistently spending the same amount as a percentage of their total on fundraising versus management versus program would give you an idea of the stability of the organization and explain if there's any significant swings. Then the last financial section that we have is Part 10, which is our balance sheet. And that has the traditional 3 sections of the balance sheet that you'd expect to see: your assets, your liabilities, and your net asset or fund balances. So these are almost always tie into the audited financial statement unless you have a consolidated audit, because each 990 has to be standalone. So if you're trying to compare an audit or a review report to the tax return, you'll want to make sure that you don't have a consolidated audit here. The items to note here, it does provide insight to the organization's health. It gives you comparative information, as we saw in expenses and income. You've actually got to go to page 1 to see that comparison, but here you've got it line by line. And you can tell here if you have restricted assets that may not be available to the organization to use in any way they would like because of donor restrictions. You won't have all the detail here. You might have to go to the audited financial statement footnotes for that, but it at least gives you an indication that some of those assets might not be available. So we had been asked to briefly touch on the new financial reporting standards and how that could impact the 990. So the first one that came to my mind when I was asked that question is the revenue recognition standard. So it could affect your Form 990 Part 8, that's our statement of revenue, but really our tax definitions that we've always had on when is a grant program revenue and when is a grant contribution revenue, those haven't changed. And audit is actually a little more in line now with the way we've already had to report it on the 990. I've not seen any other ramifications from the new revenue recognition standard that's impacted the 990, but as a general rule, the 990 is going to follow the audit. So if you do see a situation with one of your grant recipients where they have a revenue recognition footnote that says they've got to state their revenue differently than they've done in the past, you should also see that reflected similarly on the tax return. The second one is the net asset classification. This is the big one that we saw that went from 3 buckets, unrestricted, temporarily restricted, and permanently restricted, to with donor restrictions and without donor restrictions. So fortunately, the IRS found the funding on the 2019 form to actually make that change on the tax return to now coincide with the audit. So we had a year or two of disconnect, but now we're on the same page. And then for our statement of functional expense, there's lots of organizations that didn't need to have a statement of functional expense before, but they now need it. So what we're finding is a lot of times organizations were already doing the work for their tax return, as we saw, and now they're just translating that over to the audit, just a few higher level groupings. All right, Mike, I'm going to turn it over to you for Schedule A.
All right, thanks, Tracy. And now that we've covered the core form of the Form 990, we're going to get into some of the supplemental schedules of the Form 990 required to be attached, and starting with Schedule A. Now, Schedule A is a designation of exactly what type of public charity the organization is. 501c3 organizations are either classified as a public charity or a private foundation, and the organization must pass one of the tests on Schedule A to be considered a public charity. Now, on the first page of Schedule A, which you'll see snapshotted right here, you're going to note 12 boxes the organization can check. Depending on which box is checked, it's going to dictate what additional tests the organization must pass on the schedule to be considered a public charity. Some organizations, such as schools or hospitals, and you'll see that on line 1 or line 2 and line 3, they need not perform any additional tests on Schedule A itself. However, you're going to note on line 5, the IRS actually requires the organization to prove how they pass public charity tests, which we'll take a closer look at. The first one is Schedule A Part 2, and this is for organizations that typically receive most of their revenue from contributions. And what this test is it's a test that calculates how large is the donor base of the organization. And what this does is it limits contributions from single sources. So let's say if the organization has contributions primarily from 2 or 3 individuals or kind of a family, a single family, most likely it's not going to pass this test because the majority of the contributions are actually going to be kicked out of the public support test on line 5, which you'll see we have kind of highlighted with that red box there. And what that does is it kicks out from the public support test, which is public support over total support, any excess contribution right here. The public support percentage must be more than 33%. The higher the percentage, the more publicly supported the organization is. If the organization dips below 33%, it can still prove it's publicly supported. It just has to do a facts and circumstances test, which requires a lengthy narrative. Turning the page to Schedule A Part 3, These are organizations which typically receive most of their revenue from program service revenue as well as donations. So think of earned revenue with this. And what this test does is it calculates just exactly what the source of that revenue is, just to ensure that the organization isn't operating for the benefit of a small group of individuals. You're going to see on line 7A and 7B, this is where certain revenue streams are actually kicked out of the public support test, just to ensure that we are operating for a broad base of individuals. Line 7A actually kicks out revenue received from officers, directors, as well as 7B. This kicks out any program service revenue from sources which gave more than 1% of their total support So let's say the organization is operating for the benefit of maybe just 10 individuals. It might have a hard time passing this public support test because it's not benefiting the public as a whole. One thing to note with Schedule A Part 3 is there is no 10% facts and circumstances test. It's a hard 33 1/3% bright line test. Also, the organization has to have less than 33% investment income. Otherwise, that investment income creeps up too much, and the IRS says you're not operating with an exempt purpose. Turning to the next schedule, this is Schedule B, the Schedule of Contributors. The big thing to highlight here is this is not open for public disclosure. The names and addresses of the donors are actually not disclosed. However, some states do require disclosure to the Attorney General itself. So the IRS and maybe some Attorney Generals might be the only ones who can see the names and addresses of the donors, which I know is kind of a hot button for those who give to charities. Entities other than Section 501c3 organizations and 527 organizations, they're actually not required to provide the donor names and addresses. And this is kind of new law recently. What happened was the IRS in early 2019 said that these organizations can simply put NA. However, some states did challenge this and actually won in federal court. So for a brief period of time, there was actually a requirement that the names and addresses for non-501c3 and 527 organizations had to be included in the 990. Now where we stand is the IRS actually issued proposed regs to codify the change, and we're just waiting for those regs to be included in the Federal Register. And then at that point, it's likely that it's valid law that non-501c3 and 527 organizations can just put NA for the names and addresses of donors. They would still have to keep a list of those individuals, though, internally for their books and records if ever audited by the IRS. The general rule is 501c3 organizations must disclose contributions from all donors who contributed more than $5,000. There is a special rule available, though, and this allows for the reporting of just those donors who gave more than 2% of the organization's total contributions during the year. So for some organizations, you might see this list be very large if it's the general rule, or it could be very small if it's the special rule. All right, and with that, we get to a polling question.
All right, our next polling question, true or false? Some organizations can elect to limit the listing of contributors to just those donors who contributed more than 2% of the organization's aggregate contributions during the tax year. And you may select true or false. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. I'll give everyone a couple more seconds here. And let's go ahead and take a look at the results. Mike, back to you.
All right, and it looks like most people got that right. True, those organizations who complete Schedule A Part 2 can elect to limit their contributions to just those donors who gave more than 2% of the organization's aggregate contributions during the year. So that's correct. All right. And moving on, we're going to move to Schedule J, which actually is a supplemental schedule to Form 990 Part 7, which Tracy already touched on. One thing to note is this schedule is just a questionnaire for any, or at least on Part 1, this is a questionnaire regarding any types of benefits which might be provided to those individuals on Part 7. Line 1A, this asks about certain benefits that any organizations might receive. You're going to see questions regarding first-class travel, travel for companions, housing allowances, etc. So if these benefits are provided to any of those individuals on Part 7, these boxes have to be marked yes, and then they actually should be disclosed for relevant information on who participates in these benefits in the supplemental schedule of Schedule J as well. Parts 1, line 4A and 4B, this is a disclosure on any severance on line 4A and non-qualified retirement plans on 4B. If these are marked yes, then the organization actually needs to disclose who received the severance and the amount of severance. You can't get around that within the instructions. And then if any individuals have non-qualified retirement plans, and this is pretty much solely looking at 457F plans is what we see most common. The instructions actually say 457B plans aren't non-qualified retirement plans for purposes of the Form 990. You actually need to disclose who participates in those plans and any deferred compensation which might be received. One thing to note is Schedule J Part 2, which is on the next page of Schedule J. This is actually just a reporting of a subset of people listed on Form 990 Part 7. So you might see some individuals listed on Form 990 Part 7 who aren't reported in Schedule J. That's because Part 2 is actually limited to those who just make over $150,000. So you could have those who make over make less than $150,000 disclosed on Part 7, but not on Schedule J. You do need to report all formers, however, within Part 2. All right. Moving on to Schedule L, which is one of the schedules I mentioned we'd be getting into further detail. And this is transactions with interested persons. And this is really highly scrutinized from the IRS standpoint. Any transaction here, as we mentioned, it actually hinders independence of board members here. Two sections we wanted to highlight was Part 2, and this is loans to and from any interested persons. So let's say the organization provides a loan to an officer. Often we might see like housing loans to CEOs. That actually needs to be disclosed here. The amount of the loan and the balance due on the loan needs to be disclosed, and also whether that was approved by the board as well. Part 4, this reports on any business transactions with any interested persons. And typically, the threshold for reporting here is $100,000. Oftentimes, we might see board members, they might be a partner in a law firm, and that law firm might do business with the tax-exempt organization. Typically, that transaction needs to be disclosed if it's above certain thresholds, or really any other business which a board member might control that then conducts business with the organization, and the transaction is above $100K, then that also needs to be disclosed. Also, if any family member of a board member or officer receives compensation in excess of $10K, that also needs to be disclosed here as well. And as I mentioned, any Schedule L transaction actually does hinder independence of the board member. All right, and moving on to the last schedule which we'll cover, and as Tracy had mentioned here, Schedule R is the schedule of any related organizations. So if you're dealing with these multi-entity tax-exempt groups, this is where you can determine exactly who are their related organizations. Now, there must be some element of control between the organization and the related organization to be listed. And typically what I say is it's this 50% threshold. Let's say the tax-exempt organization has a for-profit organization which owns more than 50% profits or capital interest. That is required to be listed as well. If there's a nonprofit organization with either 50% board overlap or one organization has the power to appoint the majority of another organization's board. That can also create a relationship. Or what we see, there's these supported organizations. If you are a supporting organization of one organization, that automatically requires you to be listed in Schedule R as a related organization. Another thing sometimes we see is the organization might have a beneficial interest in trusts. And these could be charitable or remainder trusts. If that's true as well, those actually need to be disclosed. There is a special rule for trust, though, where you don't actually have to specifically name the trust. You just have to name the type and the amount of trusts in which you have a greater than 50% beneficial interest. So let's say an organization has 3 charitable remainder trusts that it has a 90% of a beneficial interest. Then you can just do charitable remainder trusts 3, and that satisfies your requirement for Schedule R right there. One thing I will note is that the transactions with for-profit organizations, they are scrutinized. If a nonprofit organization receives rents or royalties from a controlled for-profit organization, this can sometimes lead to UBI. So there are questions about this on Schedule R, and if they are marked yes, typically we often see unrelated business filings, the Form 990T filed, and the reason being if the subsidiary for-profit takes a tax deduction for amounts paid, the IRS is going to require the parent nonprofit to actually recognize unrelated business income just to ensure the deductions and the revenues are matching up right there as well. All right, and with that, we get to a poll question.
All right, our third polling question. Typically, for an organization to be reported on Schedule R as a related organization to the filing organization, there must be an element of control between the two organizations of what percentage? And your options are A, 25%, B, 33%, C, 50%, or D, 80%. And for those of you that would like a copy of today's slide deck, you can download them from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. And just a couple more seconds here. And let's go ahead and take a look at the results. Mike, back to you.
Yeah, it looks like just about everyone got it right. There is kind of this general 50% threshold where two organizations would have to have some type of 50% relationship, whether it's profits and interest, if it's a for-profit organization, or 50% board overlap for nonprofit organizations. So yeah, it looks like most everyone got that right. All right. Just some closing remarks regarding the Form 990 and what to take away. You know, as you're really reading this form, we wanted to just provide a snapshot summary of what we've kind of discussed. You know, if you're really analyzing, all right, what activities does the organization undertake, you really want to analyze Form 990 Part 3, which is really that PR section of the form. If you're kind of trying to take a look at whether the organization is well governed and they have in place best practices or procedures, that's Form 990 Part 6. Part 6 Section A is the governance section, and Part 6 Section B is the policies and procedures section right there. If you're trying to look at compensation and transactions with interested persons and whether they're reasonable, you want to take a look at Form 990 Part 7 as well as Schedule J, as well as Schedule L, which is those transactions with the interested persons. And lastly, is the organization financially healthy? You can see that via the snapshot on Form 990 Part 1, as well as the financial information on Part 8, as well as Part 10. All right, I think Tracy's going to lead us into a quick section on some other tax updates before we have to go.
Yeah. So we'll just take a few minutes here. It's a kind of an add-on, let you know what's happening in the law surrounding taxable or tax issues for exempt organizations. So you may have heard the celebration on December 20th, 2019, when the Taxpayer Certainty and Disaster Relief Act was signed. It repeals that horrendous provision of the Tax Cuts and Jobs Act, the 2017 Tax Reform Act, that made transportation benefits, qualified parking facilities, and on-premises athletic facilities unrelated business income. So if your organization, if you're an exempt and you didn't get affected by it, you may have heard all of the news stories about the churches that then had to pay tax on their parking lots. That's what this all had to do with. And clients had to spend an inordinate amount of time trying to quantify the costs associated with providing employees parking. So that's all gone. It was repealed retroactively, fortunately, back to the date of inception of the law. So if the organization filed a 990T and paid tax for 2017 or 2018, you can now file an amended 990T to claim a refund. So some of your potential grant recipients may be getting refunds of taxes previously paid, and then they won't need to report that going forward. We also had a provision in there that removed the adjusted gross income limits for cash gifts to a public charity that supports disaster relief. So very narrow list of grant recipients in order for the donor to get this special deduction. But normally if you're an individual or a trust giving gifts to a public charity, it's limited to, at the best, 50 or 60% of your adjusted gross income. You can't offset all of your taxable income by making charitable gifts. Well, this is an exception to that. So individuals or trusts get these suspended limits, so they can deduct up to 100% of the gift, no AGI limits, only for cash gifts given between January 1st of 18 and February 18th of 2020. And an election has to be filed, but pretty good benefit if it comes into play. Provisions that were not affected by these changes, so are still in play, are the unrelated business income activity siloing. This is something that we're dealing with right now, where each separate trade or business has to be potentially has tax calculated on it. Losses from one can't offset profits from another. What that means to your grant recipients is before, where they may not have paid tax, they may have to start paying tax now. So regulations are expected any day now, proposed regulations finally. We'll see when they actually come out. We still have the new 21% excise tax on compensation over $1 million. Probably not impacting most of your grant recipients, but if they have a highly paid person or a separation payment that is very large, they could end up paying a 21% tax. Our net operating loss rules did not change, so we still have them limited to being able to use 80% of them going forward. So again, grant recipients may have to pay more tax than they have in the past. And the excise tax on net investment income of colleges was not changed. It still applies. We did have the Secure Act that passed recently that simplified private foundations. So before, we had a 1 or a 2% excise tax on net investment income, depending on your spending rates as a percentage of your fair market value of assets. That's been simplified to be a 1.39% excise tax now, and it applies for taxable years beginning after December 20th of 2019. So this upcoming year will just have a 1.39%. There won't be the split between the 1% and the 2%. Tax returns are going to have to be electronically filed. So this is actually going to be a good thing for you as funders, because your exempt organizations, your potential grant recipients, are going to have to e-file here soon. And we believe, and what we've seen as organizations have to e-file, their returns are more likely to get rejected if they aren't appropriately completed. So it kind of forces them to do a little bit better job of preparing the returns, and the IRS has been coming out with better electronic tools that help organizations answer the questions more completely when they're self-preparing. So we'll see how this all pans out, but the 990 and the 990TF must be e-filed for years beginning on or after July 2nd of 19. That's when the legislation passed. The 990T isn't yet available to electronically file, but the IRS is telling us by the 2021 form it will be. Right now they're saying it's a 2-year delay on the 990T requiring to be e-filed. The IRS has a ton of hurdles to get over, so we don't know when it will actually be required to e-file, but it should be available to e-file at least for the 2021 form. For easy filers, so if your grant recipients are under $200,000 in revenue and under $500,000 in assets, they're going to have a 2-year delay just because of the burden potentially on organizations that are still paper filing because they aren't using a preparer or aren't using software that e-files yet. So the 990 EZs might take a little bit more time to come online, but 990s and PFs will be e-filed. We have our final polling question then.
All right. True or false? organizations which paid unrelated business income tax on qualified transportation fringe benefits in 2018 are eligible to claim a refund for any tax liability paid during these years, as this was retroactively repealed with the passing of the Taxpayer Certainty and Disaster Relief Act of 2019. So you may select true or false, and once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the CPE progress window to the right of the slide view. And let's go ahead and see what everyone thinks about this. Back to you.
All right, great, 100% true. You guys heard the cheering of the repeal. We were all very happy with that. And the last thing I want to leave you with, what's next? As I mentioned a minute ago, we're expecting a ton of guidance over the next 6 months relating to all of these provisions from tax reform. But another one that's not related to tax reform that we should be getting proposed regs on any time now are the restrictions on donor-advised funds, restrictions and guidance. The IRS came out with a notice in 2017 telling us what they thought the right answers were in relation to distributions from a DAF that subsidized donors' attendance at charity-sponsored events, so dinner tickets, at allowing a DAF distribution to fulfill a donor's pledge, and the third one is the big one, how a donor grant recipient is supposed to account for funds received from a donor-advised fund. Right now they're treated as coming from the sponsoring organization, but in the future they may have to be treated as coming from the donor advisor. We're still waiting on guidance on that. And then how private foundations are or are not able to distribute to DAFs and have that be treated as qualifying distributions or meeting the minimum required distributions. So these regs were well on their way to being done. They're expected to be issued any time now. They just got stalled out a little bit because of tax reform. I was just on a panel last week where the person at the IRS responsible for these regs said she was hoping they were going to be out before our panel. So any time now they should be out, but that could be, in the next few months. So stay tuned if you're a sponsoring organization of DAFs. And with that, we don't have time for questions today, but we'll be more than happy to get back to you. Mike and my information is here up on the screen, so feel free to call or email us, and we would be more than happy to chat with you.
All right. Thank you, Tracy, and thank you, Mike, for a great presentation today. As Tracy mentioned, we are out of time for questions, but feel free to reach out to either Tracy or Mike directly. And if you asked a question during the presentation that we didn't have time for, we will do our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. And as a follow-up to today's webcast, we will be hosting an event in Los Angeles on May 19th, which will take a deeper dive on Form 990. Please save the date, and we'll send additional details soon. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.